Hello, everyone, and welcome to Inside Industrial, Commercial Property Executives podcast covering the forces shaping logistics and industrial real estate. Join me and industry experts as we examine demand drivers, supply chain dynamics, leasing, development, and capital across assets from last mile to cold storage. Reshoring and new production are reshaping how and where space gets used. I'm Diana, Associate Editor. Today I'm joined by Matthew Ostrower, CFO at Link Logistics. We discuss leadership beyond finance, what a portfolio-wide lens reveals, how the team deploys capital across different facility types, practical approaches in build-out markets, analytics, guide decisions, and many more.
Hi, Matt. I want to start by saying thank you for accepting the invitation and for being the first guest on the Inside Industrial podcast.
Thank you very much for having me. This is one of my favorite topics to discuss. So very, very excited to be here. I love the subject matter.
Glad to hear that because we will be talking a lot about industrial today. I want to start by asking you to please share your path to CFO at Link and how your role extends beyond traditional finance.
Sure. I would say I come from a fairly untraditional CFO background. I started really in the capital markets and securities world, all within real estate, but I didn't come from that typical climb the corporate ladder or, come from the accounting side, which is very common, I think, in the real estate CFO world. I came from this analytical world where we were constantly asking ourselves questions. Of course, we're looking at what companies are doing in the short term. Are they going to make their earnings or not? But more importantly, we're asking ourselves always these big questions. What makes this company different? What is their strategy? How are they going to succeed? Can they grow long-term faster than everybody else? Those were literally my day job in the past. And so I spent many, many years looking at companies from the outside, dozens and dozens, if not more than that, of companies asking all those questions. So when I became a CFO, I would say that I really was, from the very beginning, more of a quote-unquote strategic CFO, right? And I think that's one of the biggest differences in my backgrounds and differences in my role today. The strategy department, the innovation within that all reports up into me, as does technology. Technology you'll tend to see with some CFOs, but when we talk about our strategy at Link, which is really to have the best data-driven insights in the business, to make better decisions than anybody in the business, those two things are absolutely critical, and it comes right through the CFO avenue. So I think it's been a pretty good match between my skills and my background and those needs of the company today.
Sounds like a good combination and refreshing as well.
I find it very refreshing. I think this is the way the world is moving. When you read about modern corporate CFOs today, more and more, especially at companies that are more capital intensive like real estate, the need to have the CFO at that strategy table is just going up and up and up. And fortunately, that's just kind of, it's how I was trained. It's how my mind works. This is the stuff that I really most enjoy doing. I love looking at our results. I love, putting together our reporting. I've always enjoyed that. But being able to think forward and really help Link differentiate itself, with what I think is a really different strategy. That's the stuff that really gets me up in the morning. I'm really, really passionate about, and keen to talk more about that with you.
Passion is the key. So
Yes.
Talking about the way the world is moving, industrial has been one of the most active sectors in recent years, and it still continues to perform well due to the increased demand generated by reshoring and the U.S. manufacturing revival. What do you think are the major forces that are shaping the market right now?
Sure. Yeah, I would say in the short term, we have some cross currents, and I'll talk about those for a second. But more importantly, our thesis for being in this space, for investing so heavily, billions and billions of dollars that Blackstone invested in this space, that thesis, that long-term tailwind that got us into the space, that is very much intact, if not, I think maybe even getting better than it was before. In the short term, the cross currents are really simple. We had a delivery of a bunch of supply. We're reaching the tail end of that now. We now are having, new starts, new construction that's way below, we've gone back to where it was decades ago, really. So record lows now of new supply being started. But we had a delivery of new supply. And then, of course, as you will have read about, trade remains this big topic, right, internationally. And there's a lot of uncertainty around that. Interestingly, that hasn't hurt our demand. We still have plenty of transactions, but it's really increased the amount of time it takes for people to make decisions. People feel uncertainty, so they're pausing a little bit. So those are the short-term kind of cross currents. More importantly, in the long term, we believe there are just really compelling tailwinds that should allow this sector to outperform most of the other real estate sectors out there. That is what you referred to first and foremost, e-commerce, right? This move to distribution of goods, not just through stores, but also and maybe even more so through warehouses, home delivery. That new distribution chain is really, really benefiting demand and has been for, 10 years now. And we think we're in the early innings of that when you compare it to, other countries out there. Penetration of e-commerce is still pretty low. So we think there's many years of growth in that space ahead of us. The second really, I think, big and new driver of our space is data centers. I think this took a lot of us by surprise, a positive surprise. But when we build that much new stuff in this country, that many new buildings, that has spillover impact on demand for warehouse space. The people who are building those centers, those companies need space to store their goods. That is definitely showing up in our portfolio today. And then more importantly, maybe more sustainably, all the stuff that goes in those data centers, all the different racks and all the technology, that also leads to spillover demand. Those companies store those machines and those products in a lot of our warehouse. So we're seeing a very direct impact from that. And I don't think any of us believe that the delivery of new data centers is about to slow down. That's only going to increase from here. So that's a very compelling tailwind for us. And then finally, to go back to the cross current and trade, that uncertainty, while there are some negatives in the short term, longer term, it leads to some really, really big positives for us, right? The onshoring of manufacturing, that is by itself warehouse demand. New factories in the United States mean new warehouses where those factories have to live. And then for us, we don't have a lot of manufacturing directly in our portfolio, but when you talk about manufacturing, there's spillover demand there as well. All the people who supply those factories with goods, with raw materials, that's where our warehouses come into play. And we're seeing more and more demand. We see that in the Southwest for all the new chip manufacturing that we see in the Southwest primarily. And then all throughout the Midwest and the Sun Belt, just general onshoring of new production we're measuring it every day in the portfolio. There's a lot of new demand there. So all that leads to we had some cross currents where rents have been kind of flat. They haven't gone down enormously. They've been largely flat. That's not bad for a cycle in the sector. And we really think 26, our own internal forecasts are 26 and 27 are where you're going to really start to see things pick up again in terms of growth.
Okay, sounds interesting. You did mention making decisions and a large portfolio. Yeah. Link is managing more than 500 million square feet. Can you tell us more about how scale helps you spot certain trends and make faster decisions?
Yeah, I mean, this is really my favorite topic, right? It speaks to our strategy and where I think we're positioned to win from a strategic perspective, but I think it also speaks to where real estate is going more generally. Mm-hmm. Scale is becoming this very, very important thing. People have talked about scale in real estate for many years. It's really just now, the last few years, and I think going forward the next few decades, where you're going to see scale really, really become this really important factor. Our strategy, as I mentioned, is to win with data-driven insights. We want to make the best decisions of anybody in the real estate space. Making better decisions requires, of course, very good people, but we need to arm those people with better information. And getting information in real estate has been a struggle for many, many decades. That is starting to change. Being a big company gives us access to more and more and more data, right? We see more transactions than almost anybody. We're in the markets all over the place. And most importantly, we're building a very expensive platform that really only a big company could afford to build. We're building a very expensive platform that allows us, we just have access to the data, we harness that data, we clean it, and we make it available in a variety of quite innovative ways to everybody in the company. It's called the democratization of data, right? We are feeding people this information to help our really outstanding people make better decisions. All of that is really dependent on the scale of the company. We would not be able to afford to build the platform, and we wouldn't have access to as much data as we do if we weren't so exposed through the size of our portfolio to all these different transactions and operational facets of our business. So that's really how we intend to win, right? Is having more access to data, having a platform to process that data, and then having very innovative ways of giving that data out to our people to make better decisions, whether that's what lease to sign at what rate and when, whether that's what building to buy at what price, whether it's enhancing our operations, right? Knowing where something isn't working quite right and costing us time and money, identifying that very quickly because we have the data, because that's all in our system, being able to identify that and then very quickly intervene. Time kills deals, and time costs a lot of money in operations. We're compressing those time periods, spending less money on repairing things because we're catching things early.
So about data.
Yeah.
And strategy, of course. Could you share an example of a business decision where data and analytics meaningfully change the outcome of a deal? And how much exactly are you relying on such insights?
Yeah, I mean, I would say it's not just touching one deal, it's touching all of our deals, right? And that is the power of this, right? It's not, there's one important transaction, let's go do a bunch of manual work assembling data and affect that one transaction. We are changing the way that decisions get made on all of these transactions all across the business, right? So some examples of how we do that, right? We have a system to make projections for market level rents within our industry, right? We can differentiate what are rents doing in Atlanta, what are rents doing in Dallas, what are rents doing in New York. That helps us. Those are objective forecasts. Just like any forecast, a lot of them tend to be wrong, but they may be less wrong than they were before. We're kind of constantly narrowing that band of uncertainty. We're getting higher and higher quality forecasts, and we're using those more objective forecasts. We're arming our people with those forecasts to help them make better decisions about where to invest money. We want to invest where rents are going to grow the most over a long time period. If we have a more thoughtful forecast, a more objective and thoughtful forecast that gives us a very clear conclusion about one market that's going to outperform another market, we can sell in the underperforming market and buy in the higher performing market. We make those bets. We're making those bets every single day. So that's one example. This forecasting model relies on a data platform that has 20 billion data points, right? It's a machine learning based model. So that's real technology, that's real data live and being used in a very, very practical way. Secondly, we have a database that has hundreds of thousands of lease transactions in it, right? So when our leasing agents are making decisions about what lease to sign, or we're looking at buying a property and we want to know if that lease was gone, what would be the new rent for that space? We have these comps. Those are very, very important decisions. We have these comps that we can use, more comps than we think anybody else has. We can use those comps to make a better decision, a more objective decision about those things. Again, people are still making all those decisions. We want that human judgment in the equation, but we want to arm them with more objective, better information. We create what I would refer to as another objective voice in the room using all this data. So they get a map that shows them all the different comps with the quality of assets that those comps are associated with, and they can then create some context for what they think the real market rent today is for that asset. What lease price should I take? What price should I pay for an asset? Very, very important. And then finally, I would say, it's less about an investment decision, but our operating decisions every day are informed by this data as well. We use those 20 billion data points to help identify, as I mentioned before, where there are inefficiencies in our system, right? Where are we taking too long to make a decision so a space stays vacant for too long? We've identified millions of dollars of potential inefficiencies that we can address. If you can increase the kind of the cash flow from these assets, these things trade at 20 times multiples. 20 times every dollar saved of cash flow is a very big number, and you can justify making these larger investments to give you better information about that, help you make better decisions about how to operate the portfolio. So better decisions about where to invest, better decisions about how to lease something, and then better decisions about how to operate this huge portfolio that we have. That is what we're trying to. We are trying to build the company of the future, and those are the three areas where I think we're kind of making the most innovations.
So lots of data to make the best decision for every single transaction.
Yep, to build the company of the future.
So in this company of the future, when you're allocating capital among infill, distribution, or certain specialized assets, which factors do you think matter most, and how do you think about risk?
Yeah, I mean, our investment thesis, this company is not that old. We really, depending on how you define it, we really came into existence 6 or 7 years ago. And we came into existence because Blackstone decided to make a very clear bet, not just on industrial assets and that this overall asset class would perform, but they had a very specific, and I think we now know very correct view of what was going to be happening in the sector. And most importantly, I would call it the rise of spatial economics and the importance of spatial economics in our space. What that means is location really, really matters, and it matters much more than it used to matter. If you rewind 20 years ago, before the days really of e-commerce, right, the location of a warehouse, it wasn't totally unimportant, but it was a secondary factor. Yeah. All that really mattered was how modern is this facility? What is my clear height? How many dock doors? How big is the thing? That was really what determined the desirability of a given building and a given asset. The bet that we and Blackstone made was that was really going to change, and that where the warehouse is going to matter. And so when we first started doing this, the price difference between something that was very well located, which is to say something very close to the households that all these e-commerce distributors have to deliver to. When we first started this, the price difference between something that was located close to a lot of households and something that wasn't, there wasn't a huge price difference. The bet that we made was that price difference was going to emerge, and that's exactly what's happened. The rise of e-commerce and the need to be able to deliver very quickly to millions upon millions of households, that is driving location economics in our space and making location matter much more than it used to. So we believe we have the single best located portfolio that you can assemble in the United States today. We assembled it over a relatively recent time period. We assembled it with the intention of benefiting from these new spatial economics. So how do we assess the risks? That's really, again, coming back to good data, right? If we know that we've bought tens of billions of dollars of assets and sold tens of billions of dollars of assets, we know what drives performance, and we know what mistakes we've made in the past, right? We compare our results to what we underwrote for those investments, right? That allows us to go, okay, we made that mistake before, let's not make that mistake again. So we're just very, very systematic about understanding all the things we've done, what mistakes we've made, and making sure we correct those mistakes going forward so we perform more and more consistently and much more in line with the underwriting assumptions that we've made. We make those assumptions better and better and better. So we're really using data and our now reasonable historical experience, certainly at a lot of volume, to just make better decisions and avoid some of the mistakes that we back then typically made.
So, as you mentioned, location is extremely important.
Yes.
And last mile and infill come with land, zoning, and cost constraints. And what would be the best approach that has proven most effective in such cases for you?
Yeah, I mean, but those are very real factors that you're talking about. They would say that they kind of even plague the whole industry today, right? Building a new warehouse is becoming harder and harder and harder to do. When we talk about the bet that we made on location, we made that bet knowing and expecting that we call those supply barriers, right? The barrier to building a new warehouse. We wanted to get as much money out the door and invested in the space before everyone realized how hard it was going to get to build all these warehouses. So the risks and those issues you talk about are primarily a benefit to us today because we've invested tens of billions of dollars in the space already. When you own a warehouse and no one can build one down the street and compete with you by charging a lower rent, you're in a much better place, right? And so in this last cycle, I mentioned the cross currents that we had a real wave of new supply. Our portfolio did relatively well on that because we were very deliberate about buying these infill locations close to other people, close to lots of households. By definition, if you're near lots of people, you can't build that much because it's already all built out, right? So we effectively bought locations and very deliberately bought locations that were so-called protected from new supply. So those zoning constraints, all that, we're generally very, very happy with that because it means there won't be a lot new competition for us. But it is a double-edged sword. We do develop as a company. We have a large development pipeline, and it is a challenge for deploying new development money, right? It's very, very hard to make those deals work. It's very, very hard to find locations where you can build. I would say, again, that's where our scale and our data, our competitive advantages really, really come into play. I think you need to be more and more sophisticated in order to know which bets to make on which raw land to buy that you can actually develop. And it's more and more expensive. It takes longer and longer. You got to be able to carry this land, which is expensive, for a longer time period. So being larger, we can support those kinds of investments. That's another advantage from scale. So we use both our data advantage and we use our scale advantage to do more in the development space.
So how do you weigh redevelopment versus new construction? Which one would you go for?
We like both.
Okay.
And I would say we were fairly indifferent between the two. We are driving for risk-adjusted returns, and we're pretty disciplined about how we deploy capital. So when we look at a redevelopment or we look at a development, again, we use our data and we say, what have we done in the past? Where have we made mistakes? We underwrite them and we come up with what we think are more accurate projections than most other players in the industry can come up with. And then we say, what are the risks behind those? Where are the more compelling risk-adjusted returns? And we choose those returns. In many cases, in many markets, we're doing both redevelopment and development. Redevelopment oftentimes is happening in more infill locations. There is some development opportunity, which we have in our portfolio in infill markets, but redevelopment is typically the way you can expand something that's already in a fairly built-out community. And so you'll see us leaning on that more and more because of the locations that we've chosen in the portfolio. But if we can find a location that's greenfield today that has not been built out, but we think has real proximity advantages and there's not tons of other raw land right around it, we'll do that development as well.
So Link has rolled out tools that improve transparency and energy performance. What impact are you seeing from tenants and from your own operations?
Sure. You're referring to energy solutions, which also feeds into our scale and data advantages. We built a customer-facing tool that allows our tenants, our customers, as it were, it allows our customers enormous transparency in their consumption of energy and the opportunities they might have to save money and build efficiencies in that energy consumption. That was not an inexpensive undertaking. We did it for the benefit of our customers in the hopes that we would build more loyalty with them and improve what we refer to as our retention ratio, the number of customers that stay when a lease ends versus going to another location. We did it with the whole idea of building our relationship with our customer base. But it was expensive and it was very, very data intensive, and it requires that database of historical data to understand, what's efficient, what isn't efficient, to give people the insights that they're going to need, to give those customers the insights that they're going to need. We also, based on our scale, we procure energy for our customers increasingly, and we hedge on their behalf. If you were a consumer of energy news over the past 4 or 5 years, there have been a number of instances where there was a huge freeze that happened, say in Texas some time ago, and energy prices in the space of 2 or 3 days could spike 4 or 5, 6 times, maybe even 10 or 100 times depending on the location. You could end up with these massive energy bills that focused our customers on wanting to manage the volatility of the cost of their energy consumption. So given our scale and our sophistication and our data platform, we were able to build a hedging strategy for them as well. And I would say, it's played to really, really positive results. We don't charge for this, right? This has really been about, let's do something for our customers. We want to partner with them. And the hope is that they want to stay in a Link facility. We'll get paid when they don't leave at the end of their lease. And there is some encouraging data on that we're seeing already, that we definitely get lots of positive feedback about the program, but it seems to be starting to actually generate real numbers for us, improving our ability to keep tenants.
It's great. Having a good relationship with the customer, it's definitely the key in the industry. So Matt, based on your experience, and if you were advising a mid-size owner or investor entering the industrial sector today, what's the one capability you would prioritize first?
Well, first I would tell them, don't do it. Right? Because, I mean that in a sense, right? That I think the disruption, when people think about disruption in the real estate space, they tend to think about, I can buy something online instead of in the store, and that might make a physical store less valuable. Or they think about, I can now have a meeting like this one online on my screen instead of going to my office, and that might make office less valuable. That's the disruption that people tend to think about, instinctively in real estate. And those are real examples of disruption. I think the type of disruption that I think is coming in real estate is how these companies are run, regardless of what asset type they're in. The need for scale, the need for data, the need to inform your decisions better, to operate your portfolio. And if you have scale and you have data and you have a platform to utilize it, you can make better decisions and operate better. That is really, really important. So I would say that to anyone coming into the space, but to a small or a mid-sized player, that should be something that's somewhat daunting, right? And they should ask themselves the question, should I do this alone and try to build all this stuff by myself? Or should I try to leverage the platform that somebody else has? And I think you're going to see that more and more, that there's going to be favor cast upon the larger companies that have been able to make these investments, these legacy investments, and improve their processes and decision making. They'll benefit when some players say, I'm not going to go do this alone. I'm going to create a JV with somebody who can help me operate and make these decisions better. I will say, I think there will always be room for new entrants, especially on that smaller size of the spectrum, that local sharpshooter who just knows more and they can micromanage every little aspect of their asset. I don't mean to downplay that, and that's really important, but they should also be looking at ways to leverage the company of the future. What things do they need to do differently over the next 5 years versus what you might have done for the last 25 years? Because things are changing. Data is becoming more available. Technology is getting cheaper. You need to run your company differently than you did, say, back in the 1990s or even the early 2000s. If you're doing it the same way, you're missing something, right? You're leaving some money on the table. You might want to spend, you might need to spend huge amounts of money to make it really differentiated, but even small sums of money can change the efficiency and the performance of even smaller companies.
So really great advice. Thank you. Looking ahead, what would you say is the biggest opportunity along with the biggest risk in today's industrial real estate?
Yeah, I think we have coming a very good recovery in the real estate, right? In the fundamentals. We talked about the cross currents, and then I said there are these tailwinds. I think the cross currents allowed people to kind of, maybe even question the long-term thesis on industrial, and that shows up in the space quite often today. It's not the darling that it used to be in some ways from an investment perspective. That creates a contrarian opportunity, right? And some of the markets that were hit the hardest are going to be, if they're not today, in some time in the next year or two, they're going to become real investment opportunities. So seeing what's coming in terms of a recovery and knowing where that recovery is going to be the most pronounced because you have the best forecasts and the best insights on that, that's going to present, I think, a really big opportunity. And then, maybe I sound a little bit like a broken record, but that ability to modernize your operations. If you're a big investor, a big established company today, most all of these companies have the opportunity to save themselves huge amounts of money, even in the short term, by spending some money, getting your data in the right place, getting it cleaned, and then doing the change you need to do internally so people use that data even better. You're not going to be surprised to hear me say I think that's a massive opportunity in the space. It's certainly the opportunity that we've decided to exploit first and foremost, but we won't be alone in that. I do think we're ahead, but I think there are going to be many, many other legacy players that are going to see that benefit. And there are ones today that are already starting to do it. So there's going to be, I think there's a real opportunity. You can talk about whether you can outcompete on that, but you can just make what you do today that much better. You can generate more cash flow. You can make a better investment decision. Maybe you won't make the best. Maybe you won't outperform everybody, but you can certainly perform better than you were, 5 years ago. And that's, I think, a huge opportunity that is, it's starting to be tapped, but it's largely untapped in the real estate space.
Okay, so it all comes down to data and strategy, basically.
I think you got to have a strategy, and real estate historically, there's not been a need for a lot of strategy. It's been go build the biggest portfolio you can, investing money, right, and trying to generate returns. And that is a strategy of sorts, and it's worked for a very long time. But I think as the world gets more sophisticated, real estate's going to have to get more sophisticated, and investors are going to want to pick their battles. They're going to want to say, I'm going to invest with you because why? What are you going to do differently and better than everybody else? So as a real estate manager, you need to have an answer to that question, right? What do I offer that's truly unique compared to everybody else? And I think people have been trying to answer that question for a long time. I just think the new tools and the new data that are becoming available allow you to now actually differentiate yourself more and more in the space.
Thank you so much, Matt.
Thank
it was
you.
A great conversation. Maybe, hopefully, we'll get to record another episode later on.
Sure.
Who knows?
Anytime.
But again, thank you for accepting the invitation. I had a great time and it was a pleasure.
I enjoyed it thoroughly. Thanks for giving me the time.
Stay tuned for the next episode and feel free to rate this one if you've enjoyed it. For more commercial news, trend stories, and podcast episodes, visit cpexecutive.com. Moreover, don't hesitate to join CPE Executive Council. Every month, we discuss the latest trends and topics with leading experts in the field, and your input could be extremely helpful. To join, please send an email to jessica.fiur@cpe-mhn.com. Have a great day.